Hi there. I am here to help take the mystery out of a mortgage. I'm Patti Handy, your financial coach and mortgage advisor. Oftentimes I'm asked what goes into the pricing of a loan. So how do I get the rate quoted to me, and what does it consist of? Well, there's many factors that go into pricing a loan. So when you are taking a look at various lenders, make sure you compare apples to apples. So part of the equation, if you will, is your FICO score. The better your FICO score, the better your interest rate. So that's why I always talk about make sure you pull your credit, speak with the lender before you're looking at buying a home, get your credit report, make sure there's no errors on it, look at your scores, and if you can improve the scores, and there's an opportunity for you to increase your score with some work, do that, because that will help you save thousands of dollars over the course of your loan. So FICO score is one of the first fundamental pieces that go into the pricing. Loan to value. So if you're putting 20% down, there's going to be a different pricing than if you're putting 5% down. If it's a second home or an investment property, there's a pricing hit for a second home and an investment property versus being your primary home. If it's a condo, there's a pricing hit potentially. And again, that depends on your FICO, your loan to value. There's like a matrix. So there's, this is not complicated, but it's a matrix. So it could be a condo hit if you're at a high enough loan to value. Your debt to income could potentially have a pricing hit as well. So debt to income is your debts outstanding divided by your monthly gross income. And the lender will help you kind of navigate those calculations, because the front end score, if you will, is just the mortgage piece of it, the mortgage, the property taxes, the homeowner's insurance, and the HOA. And then the back end is the front end plus any monthly obligations that you have as far as credit card, auto payments, student loans, any other toys that you have, boats, RVs, any other obligation that you have on a monthly basis goes into the back end calculation. So if your debt to income is too high on the back end, there's going to be a pricing hit if it can be done at all. If we're doing a refinance and we're pulling cash out, there's going to be an additional pricing hit than as compared to if you were just doing a rate term refinance, meaning you're just refinancing the existing loan amount, you're not taking any money out. You can roll closing costs into your loan, which is fine, but there's a pricing hit if you want to pull cash out and use that money for something. So there's a hit for that. And if you're doing a first and second combined, there's often a pricing hit for that. So it will depend on the various factors that I had just mentioned, and a combination of them to determine what the pricing hit will be. So my recommendation to you, when you are first considering buying a home, talk to a lender and have them do a credit pull. It has to be a hard credit pull, ideally, because that is what we need to get you through pre-approval, and most realtors won't take you out without a pre-approval letter, because you need to be ready to write an offer. And the only way you can write an offer is if you have a pre-approval letter saying you are ready to go. So feel free to reach out to me anytime. I'm happy to assist. If you're watching on YouTube, please subscribe, like, and share. I'm going to be uploading videos here weekly, and we'll welcome your questions and we'll answer them here on the YouTube channel. All right, again, feel free to reach out to me, and look forward to speaking to you soon. Bye for now.